Subscribe to our channel and press the bell icon to get the latest notifications.
Hello friends, welcome to our channel. In this video, I Mayank am going to discuss with you an important topic. The topic has been in news recently and most of us must have seen it. So it is important that we actually understand what this terminology is to make sense about what the news is and its implication, which is very useful for the exams for which we all are preparing. So the topic of this video is ways and means advances. Those of us who don't know what this terminology is, what it does and how important it is, just stay tuned with the video because this video will help you not only understand the terminology but also give you a good idea about why why it was used in our economy, and would also help you to understand how important its role is in the economy at this point of time. So let's move to the news first. Recently in the newspaper, a news came up that Reserve Bank of India in consultation with Government of India has decided that the limit for ways and means advances for first half of the financial year 2019-20 will be 75,000 crore. Now those of you who are watching me can clearly understand that I have simply read the news on the screen for you. Why I have read it? Because it has a significance to hold. The news has certain terminology called ways and means advances, which is the topic of our video and we'll going to discuss it. Also, it states that for the first financial half of financial year, that is from April 2019 to September 2019, 75,000 crore have been allocated to it. Also, I would like to add to it, once central government covers 75% of this 75,000 crore, it will be in the authority of RBI to actually fluctuate this amount and increase or keep it same. So you must be thinking that yes, we have got an idea about something called ways and means advances and it has been allocated a certain sum. But firstly, we need to actually understand what this terminology is to be able to make sense of this news. So ways and means advances, what it is something which you will understand once you understand why it came up. So I will be explaining you through a simple story that why do we need a system called ways and means advances in India. What happened was in 1950, when the central government was low on funds, clearly India got independent and the government was facing many kind of challenges in front of it to run a nation which was under British rule for a long time. So the government was clearly low on funds. Now what happened was that since government was looking for funds, they actually thought of going to one of its closest and one of its most important arms, which was Reserve Bank of India. So it was decided with between the central government and the Reserve Bank of India that the central government must keep a minimum cash balance of rupees 50 crores with the Reserve Bank of India on Fridays and rupees 4 crores on other day. So if you are a person and you have to go to your bank, there is a provision in every bank that a person cannot have a zero balance account. Although there are people under the scheme, a government scheme, that they can have zero balance, but in general sense, a person has to keep a minimum balance in their account. So this is what the RBI and the government decided, that RBI is a banker to the government and government said, okay, I will come to your bank, you have to, and I will deposit money. You have to make sure that my balance does not go be less than 50 crores on Fridays, which was the end of the week, or 4 crores on other working days, so that the country in case of necessity must have something to fall back on. So what happened was that to adhere to this administrative arrangement, it was agreed. So further it was agreed that whenever the cash balances fell below 50 crore, that is, government was not able to meet its target of minimum balance in its bank account, it was the RBI who has to issue treasury bills called ad hoc T-bills to the government to meet up the deficit. So it was the responsibility of the government of the RBI to issue fresh ad hoc treasury bills to the amount which would actually restore the balance to 50 crores. So these bills were ad hoc, that is temporary T-bills, as you can see. So this was the arrangement in 1950s. But what happened was, as a result of these T-bills being issued, the governments which came further in future took excessive liberty. They felt that need that they actually would go on launching schemes without thinking about deficits, because whatever the deficits were, the burden of meeting those deficits would always fall on the shoulders of RBI. So now government was going on and there were constant defaults by the central government on the pretext of the development factors that they were undergoing, that RBI was facing huge problem, because now they had to very often, and in fact this provision which came up as an alternative situation, that is in case the government defaults, had now become the permanent situation, that is our government would default. So RBI had to always be ready that they had to pay back. This has become the situation. Now viewers, you can imagine that the situation would have been so tense, because RBI, instead of making policies for the monetary development or to keep a check on a inflation on a country which was growing in its nascent stages, was actually paying the bills for the government, that is was actually funding the government schemes. So it was an excessive burden on RBI for a work which actually was never assigned to it. So it was doing a job which was extra, or which was due to a mutual agreement doing, and was not able to perform well. So what happened was, because of this impact, the Reserve Bank of India's credit to the government as a source of reserve money was wiping out. That is, their reserve money was going down. As you can see, inappropriate spending of reserve money was there. Now, there was a chain of events which had an impact. Firstly, the source of funding for government expenditure increased. Definitely, since RBI was also funding government expenditure every time, the source increased. But because the source increased, the resources were used. That is, the resources which must be kept were actually used. Because the resources were used, there was monetization of deficit. Now, what is monetization of deficit? Monetization of deficit simply means the amount of things which is the dated security, coins, treasury bills, rupees, all those things which belong to central government and are kept with the RBI, and in place of these assets money is being pumped in the market. So there was a monetization of deficit, that is the deficits were being monetized or money was used. And in these monetization of deficit, there was a huge increase in terms of government securities being deposited with RBI. As a result, RBI was expected to compulsorily finance the ad hocs. So RBI now had to actually finance the ad hocs. Government would simply provide its securities to RBI, and RBI in return had to fund those ad hocs or fund those deficits which were there in the government spending. Now RBI, once it used to provide money to the government and government used to circulate it in public, there was high inflation in the market because people were getting more and more money. So you understand the concept that when you don't have demand but you get excessive supply of money, you actually start buying goods which you don't need. So there was inflation in the market. So overall it was a very bad situation. Also, there was increase in deficits. Yes, we just saw that excessive burden on RBI. Now, RBI was actually forced to do a work which was not its own. So there was huge burden on RBI, and autonomy of the RBI was going down since it could not formulate policies to actually curb inflation. But in a way, if you could see that its mechanism was actually increasing inflation rather than curbing it. So there was no authority in the hands of RBI to take decisions. Now, you must have visualized how catastrophic that situation must have been for the economy. So, what needs to be done to eliminate that? So, to eliminate that, earlier the provisions were to limit, that is, you have to limit the creation of T-bills. Make sure that these T-bills are not created any further. So, there was a limit put on that. Later on, introduction of ways and means advances. Now, ways and means advances was the topic of our story, and you by now have thought or have got an idea that what the situation was and how ways and means advances was needed for our economy. So now in further, I'm going to explain to you how ways and means advances actually help the economy. In 1997, it came up as an idea, but there was a problem that what if the government defaults? What if the government is not able to repay? And there was quite likely chances that government will default anyway. So what happened was they actually wanted a full-fledged mechanism, not just an idea, that what will happen if there was a default, how will they back it up. So by 1997, this idea turned into a full-fledged mechanism in 2 years, that in 1999, and was implemented. So now the question, what is WMA? Now you know that this is something new, but you don't know how better it is from the old one. It won't create excessive burden. What is the guarantee for that? Next was, how is WMA applied on the central and state government? Now, government has their own decisions. It was not something like ad hoc tables, a simple agreement that you will help me or you will fund me and RBI would be there. There has to be an agreement. There has to be a mechanism for separate state government, that is center and state. Who will decide the limit? How will the limit be decided, that how much money is to be given to states, how much to the center? What if the government is not able to pay? That is, what if the government is says that they don't have the money to pay it back to RBI? Who will now, whom they should go to? What is the interest rate? All these questions will be answered now. Firstly, what is a WMA? So WMA is basically a bill or temporary treasury bill issued by the RBI to the government to meet the mismatch in their payment and receipt. It is also a treasury bill. The earlier was also a treasury bill. The difference here is that now we have a mechanism. It was not earlier a simple agreement with no date, with no specification, with no idea that how it will be repaid. Just a simple agreement with no future consequences in mind. This time we had a full mechanism and we were fully prepared. It is a temporary bill which needs to be vacated after 90 days. The interest rate to be charged in this bill, since it is a loan, interest has to be charged, would be what the repo rate in the market is. The interest on overdraft, that is in case of overdraft, that is if the government says they don't have money and want an extension to pay back the loan, that period will be called overdraft. So in period of overdraft, 2% above repo rate. So if repo rate is 5%, during the tenure of loan you have to pay an interest of 5% on the principal. And if you say that you cannot repay it after the period, you have to actually pay 7%. That is, in the overdraft period you have to pay 7%. Overdraft cannot exceed specified time. That is, it cannot be for years that the government is delaying to pay back. It has to be 10 days, not more than 10 days in case of central government and not more than 14 days in case of state government. Also, it is important for us to understand that for state government to go to RBI for loan, there were two provisions, that is special and normal. In case of special WMA, it was provided against the collateral of government securities. So it was provided against the collateral of government securities. That is, they had to give government security to RBI to actually take that loan. And in case of normal, the bill was issued to them based on past 3 year performance. It is simply like if we go to bank, if you go to bank, then bank will assess how much income you have and whether you are capable to pay back the loan or not. So based on past 3 years performance of the state in terms of revenue generated, the amount to which or up to the amount to which they can be issued a loan is decided, and then loan is issued. So clearly we have a much better mechanism to ensure that there is some recovery in the loan. Now, one thing you must be thinking, okay, this time we have a better mechanism, we are better prepared, but what is the guarantee that there will be no loss? So to ensure that this is different and this is better from previous version of our system, what they did was, there was firstly a transparent way of reporting monetized deficit. How transparent way? Transparent way was there because conventional budget system, that is earlier what the budgeting was done, was now replaced. In the new budgeting system, the budgetary deficit was discontinued. So now if the government wants to show its deficit, it is not budgetary deficit, it is the fiscal deficit which is important. So fiscal deficit clearly talks about revenue minus expenses. So you don't talk about fiscal deficit wherein you have to predict the losses, and based on those predictions you decide whether it is gain or loss. Rather, it is simply what is visible on ground. You cannot say, or you, the scope of manipulation is very less. So in case, instead of budgetary deficit, now we had fiscal deficit system of budgeting. Also, data security and auction treasury bills, these two things are shown very clearly and separately in the accounts. So there cannot be any inflation of assets or loans because these two assets are shown separately in the accounts books of the government. So these kind of provisions made it more transparent for the public and for the government, for the experts to understand what the status of government is. Next better thing what happened was that there was fiscal discipline. Now there were limits being implemented on the loan. So you can't just go to the RBI and take loan being a state or a central government. You had to actually adhere to the limit up to which you have to pay. You have to get the loan and you have to pay it back. Autonomy to RBI formulating and implementing policy. What it happened was that earlier RBI was not able to perform its task, but now because of this provision, RBI got enough strength and the authority to actually implement its provision or implement its task of planning monetary policy and also curbing inflation in the country. So now what happened was that, okay, we understood, but what will happen on ground? How will the loan or how will the bills be issued? So there are two things to understand, that in case of central government, there's a different mechanism, and in case of state government, there's a different mechanism. So when a central government goes to RBI to take loan or to take ways and means advances, the amount is decided in consultation with RBI. That is, central government and RBI together decide the limit up to which they can take the loan. Secondly, the overdraft facility is there. That is, in case the central government, after even after deciding the amount, is not able to repay it back. So what happens is, if the government says that it will take, suppose, 100 crore loan bills from RBI for a period of 100 days. So right, so for a first 90 days, the interest charge on these bills would be what the repo rate is. After 90 days, that is the remaining 10 days, the interest rate to be charged would be 1% over repo rate. And in case the government, even after using it for 100 days, is not able to repay it back, it wants an extension, and the extension can be maximum up to 10 days. So on the remaining 10 days, the government will have to pay a interest of 2% over the repo rate. So this is how the interest rate increases, and a mechanism is there to keep a check. Well, in case you are a state government, then there's a 90-day policy. Unlike the central government, you cannot decide the duration. You have to take a loan or the bill under the ways and means advances for only 90 days. It won't be extended any further. So maximum days you have is 90 days. Now, the state government, however, has an option to first go for special drawing facility. These are kind of loan agreements where a collateral is to be issued. So unlike other advances, here state government has to give a collateral to RBI, and in return RBI provides them with fund. If the collateral gets is not there, or they don't have that collateral, what they do is they go for ways and means advances. I just discussed with you the two types of ways and means advances. In case after getting a ways and means advance for 90 days they are not able to repay it back, they have to also go through overdraft, and this time they have to pay over and above 2%. That is, whatever the repo rate is, they have to pay more than that. How much more? 2% more. And in case of state government, the provision cannot be more than 14 days. That is, if they use a loan for 90 days, then for 14 days they can more take to repay it with 2% charge, but not beyond that. Now, this is something to pay attention. We understood what ways and means advances is, but the government of India needs to keep 100 crore with RBI. So earlier we discussed that the amount was 50 crore, but now it has increased to 100 crore. So on some important days such as Fridays, that is the weekend, the closure of government financial year, or on 30th June, which is the date of closure of annual accounts, on all these days the government of India must have a balance of 100 crore with the RBI. Otherwise, a minimum balance of 10 crore needs to be there kept by the government of India with the RBI to actually have funds in case of any necessity. So this was all about the ways and means advances, and I hope that you understand what we mean by increasing the limit of ways and means advances, and you could understand the news. Hope you liked the video. Don't forget to subscribe to our channel for such enriching videos. If you have any queries, email us at successrbi@anujjindal.in or call us at 9999466225. Thank you.